On these slides, we're going to look at how cash disbursements to suppliers are handled. This is an important concept because for many companies, payments to suppliers are a major use of cash. The focus is on the timing of cash payments to suppliers. Obviously, sometimes supplies are purchased for cash, so the timing is immediate. Often, there's deferred payment of cash, and it's those deferred payments that we're most concerned with. Here's an example where we have scheduled purchases for January, February, and March. The units cost $10 each, and the payment schedule is that 80% of the cost of the purchases is paid in the month of the purchase and 20% in the following month. You can see I've laid out the cash account for 3 months, January, February, and March, and also an accounts payable. To get started, I've added a cash balance of $100,000. Now, the purchases for January, 3,220 units at $10 or $32,200. That would be debited to inventory. The credits are 80% of that cash, $25,760, and 20% of that amount accounts payable, $6,440. To calculate cash for February, we bring forward the balance from January, and then we account for purchases of 3,440 units. You can see the credits to cash and accounts payable. We are, however, not quite done with February. We have to remember that 20% of January's purchases were on account, so those have to be paid in February. You can see the debit to accounts payable and the credit to cash. In March, we're going to follow the same two-step process. Account for the purchases made in March, and then also account for the payment of cash related to purchases made in February.